Welcome to the Traders Clinic, your regular shot in the arm of trader insights, philosophy and knowledge, brought to you by two professional money managers, Ali Crooks and Charlie Burton.
In each show, we tackle your burning trading questions and cover all things from the world of trading. So we're back. Good to see you, mate.
We are. Likewise. Well, it's been at least a week. We've both had the lurgy, haven't we?
Yeah, we both. I'm feeling better today, though, and you are as well. So
good.
let's, looking forward to getting into these. So we're off. Today's subject, or today's, I think, main core theme is one you came up with, which I really like, which is the advantages of being a pessimistic trader.
Yeah, the problem that a lot of traders have is they bury their head in the sand. So they get into a trade and, I don't know, maybe the trade's moving around a bit for them and they don't want to think about, well, what if it rolls over? So they bury their head in the sand psychologically and just, they live in hope then. They just hope that their trade is going to reach their target or they're going to get to a point where if they're trading their stop, whatever their exit method is. And I think I called it being pessimistic. I'm not meaning being pessimistic generally, but it's the old adage of under-promising and over-delivering. So if you under-promise to yourself, you get into a trade, even before you get into a trade, you might say, this trade may well stop me out. Just, literally you get into a trade and it almost becomes a straight stop out. Those sort of trades happen. And then you also have those trades where you get into a bit of profit and then it just seeps and rolls over. So if you work on your mindset that, okay, this is a scenario that may well happen to me in this trade. If it does happen, then at least psychologically you're prepared for the trade to roll over, stop you out or whatever. And by being psychologically prepared, you're not suffering with frustration, all those other emotions you might have, disappointment, whatever. Because if you have those emotions, then they carry over into the next trade. That's what we're constantly trying to do, is not about this trade, but the effects of this trade on your next trade and the trade after that. So if we can under-promise, be a bit pessimistic, as far as the trade is concerned, if it does roll over or just become a stop out, then we've already dealt with it or been dealing with it, so we don't have those heightened emotions of disappointment, etc. If the trade works itself out, well, that's fine anyway. So we've already prepared for the worst case scenario. If it works, then fine. So anyway, over to you.
I think I like the concept and have used something similar. So I say it's the difference between thinking negatively and being a negative thinker. We're not saying go out there and be a negative thinker, but don't hide away from the negative aspects of what could happen on that trade. And it's almost the more hopeful, the more positive, the more you're focused on the trade winning. It's almost directly proportional to how much, if the trade loses, you're then going to feel upset. It's like seeing somebody, and we've seen them on the TikToks, these guys who get overly hyped and start jumping around when they've had a winner. My first thought is, well, how emotionally underwater are you going to be if you have a loser? So I think it's good practice because it's neutralizing the want and desire for every trade to be a winner. And most traders know logically that they're not going to win on every trade, but emotionally, are they avoiding thinking about the fact that 50% of all the trades they place over the next year are going to be losers? And preparing yourself for that, like you said, means that once that trade comes along, if it does lose, you're not bringing that trade to the next trade. And that's something I really try to install in traders is how good are you at not bringing the baggage of the previous trade into the next one? And this is a really good way. But I think sometimes people want to be or are only overly positive because in a way they know logically they can't convince themselves the trade's going to win, but there's on some level they're hoping that well, if I just hope the trade's going to win and avoid thinking about the loser. And I think it's also relative to what happens during the trade. So if you've had a trade that goes into profit, like you said, then a move back down into a losing area can almost feel worse because you've had the week, 2 weeks, a day, 2 days, however long, with that trade being in a profitable position. Once it then slips down and goes underwater, it can almost shock the trader because they've almost expected the trade to only go one way. Yeah,
absolutely. And we'll talk about that as something else. We've got another subject on that. But coming back to the emotions, because this is what we're talking about. It's how this trade impacts future trades, because if you're frustrated in this one, you take that frustration over. It means that you could overtrade, revenge trade as a result, and this is why it's so important. So what we're both saying here is we as much as possible, if this is our potential emotional range, we want to desensitize that to just like a little ripple on a pond rather than a tidal wave coming in, so to speak. So the more that we can desensitize our emotional range, we're still going to respond. We're still going to have an emotional response to a trade, as you've just said, which was in profit, rolls itself back over. There is going to be an emotional response, but if the more that we can desensitize that emotional response, the better we're going to be.
Yeah, like that. Which I think it does. I mean, it leads lovely onto the next element, which is, it sounds counterintuitive what we're saying now, just after what we've just said, but actually it makes a lot of sense, which is turning those negatives into a positive. So you've accepted the negative side of the trade, but what happens when the outcome is actually negative? How do you turn that into a positive?
Yeah, exactly. It's turning negatives into positives is something which we should be doing all of the time. So there are negative situations in trading all of the time. The market's constantly trying to upset you and push back against you, and it gives you those positive trades, of course, but there's, like you've just said, half the time it's going to be throwing all sorts of scenarios at you. Uncertainty. It might even be that you're in a trade which is profitable, which actually does become a closed profit. However, along the way, the market might create pullbacks, which create uncertainty, and then you can start getting negative when it starts pulling back. And so you've got to constantly look to turn that negative emotions into positives. So, for example, if we're talking about a pullback within your trade, you've not even been stopped out, and so certainly say, well, look, this is within the normal realms of trading for this market to be able to be doing pullbacks. It's perfectly normal. So what's the point in me even being negative at this point? But it's very easy to get caught up in that.
Yeah, I agree.
And it's very easy to get caught up. The easier one is, you just had a few losers on the bounce, and then you get very negative. And yet realistically, if you take a larger sample size, then you would say, well, is that perfectly normal? Yes, it is. So turn negatives into positives. And another one, you had some as well, is the typical one is you've just been stopped out only for then price to carry on up in the direction of your trade. And a lot of traders would get frustrated at that. Well, turn a negative into a positive and say, well, actually, at least my analysis was right, or at least the overall trade was right. Yes, I've been a bit unlucky getting stopped where I've been stopped, but it doesn't necessarily mean that you have to change things for the next trade. Sometimes it's just unlucky, that you just get nicked out, and that you don't have to always fix something. So turn that into a positive and say, well, at least the overall analysis was right. And if I took 100 trades like that, well, yeah, I'm probably am going to have a few that are going to nick me out, but there'll be plenty that don't and that work out. So constantly turn negatives into positives, because again, it comes back to what we just said. That helps you with your emotional range. Otherwise, you're just swinging around the emotional spectrum. We might as well send you straight off to the Priory Clinic.
I'm sure there's been a few traders that have ended up there. But yeah, I think primarily turning the negative into the positive is a lot of the time about expanding what I call your space and time horizon, because it's very, very easy to become negative about the individual trade or the last 2 or 3 trades, if you said, or something specific about the trade, like you mentioned, which is you get stopped out and price ends up going the way you want. But one thing you said I think that's really important is this idea of, well, let's expand that over 100 trades. So if I followed my plan, I was right about my analysis over 100 trades, would that work in my favor? And being able to do that, take the short-term scenario and look at it over a bigger picture, look at it over 100 trades, look at it over 2 years instead of 2 days, is going to help turn those negative situations that are negative in that moment, turn them into a more positive and create some sort of behavioral change that is consistent. Because one of the things I see so often is traders will be consistent with a strategy or a thought process for 2 trades, and then something happens in the market and it all and that new thought process or new analysis technique just goes, and they're, like you said, trying to fix it or change something. Whereas if they can expand that time and space horizon and see what they're doing is right over the longer term, there's more chance of them sticking to it.
I think the difficulty especially for newer traders, is they don't have the experience of knowing that over the longer term, what they're doing is going to work. So there's a leap of faith element. They have to sort of trust in what they do. And that then brings them back to some back testing and things like that to help with the confidence with the approach that they have, the method that they're using, because they don't have that experience to say, I've been through this before.
Yeah.
Necessarily. I've been through a drawdown, I've been through this or that. So there is an element of a leap of faith, but that's where these other aspects of trading come in, isn't it?
Yes, making sure you've got some data behind what, some data. You're not putting all your eggs and all your hopes and dreams in that one bit of back testing, but having it as a reference point is another way of looking at a longer sample size. So I think that's really key. Good stuff there. Yeah. Our question. So we got a really interesting question. So, is 3% a week a good target to have? Where do you start with this one?
Do you want to go first?
I'll go with this one. I think I'll give a bit of a politician's answer. It depends. The first and foremost with this is, again, it ties back to what we've just been saying, is what I don't like about a question like that is it's a very short-term, it makes the trade a short-term focus. So the risk there is, what do you do if you get to Wednesday and you're at 2.5% for the week and you've done everything right, all of the trades that have come up you've taken correctly? Do you aim and push to get your 3% for the week, and then as such you start taking trades you shouldn't, you start over leveraging or whatever it is, or do you tighten up because you've nearly hit your goal for the week? So for me, having a goal, having a weekly target from a mindset point of view brings in all of these other factors where you're chasing this line in the sand, this arbitrary line of 3% per week, when actually the market might not be offering you 3% that week. Do you then get despondent if you're -3 for the week? Because I'm assuming that the person asking on a weekly basis is a day trader. So they're going to have big fluctuations. And the other challenge I see is a lot of people will have looked at their numbers and maybe they've done some work and said logically, well, hang on, the strategy performs this much over a period of 6 months or a year. So if I average that out, that works out at 3% a week. But the challenge is you bring in random distribution, you bring in market conditions, all these other things that will impact that. 3% might be the average figure, but you might not be getting that every week. And I think that's the challenge. It's very short term in its focus, and also it's creating this arbitrary benchmark that just might not be possible that week.
Yeah, and I think there's this other thing of having realistic expectations, because 3% a week, that's 12% a month. That's 120% non-compounded a year. Now, if he's day trading, therefore, really, we're probably looking at, I don't know what that is compounded, but we're probably looking at about 150% compounded figure per year. Is that realistic? It's not that it's not achievable for a retail trader to make 150% in a year, but I think that people need to have more realistic lower your expectations, because the higher your expectation is, the greater the degree of disappointment and potential for disappointment. Disappointment equals emotions, like we've just been discussing, and you become more emotional. What he's better doing is focusing on the process of being a good trader. The 3%, the 12%, the 120, whatever the percentage return is, chuck that in the bin. And your focus should be, can I be the best executing trader that I can be? That's what his concentration and focus should be on. If your focus is on the end result, then how are you being the best trader you can possibly be? So forget the target, especially on, like you've said, such a short window there on a weekly basis. That's what, yes, a lot of the masses out there are thinking like, and we all know what happens to the masses, don't we?
Exactly.
So, yeah. So I think that having goals, as we've said, it's a very dangerous thing to do, because you're tying yourself to the calendar, which is ridiculous.
Yeah. It's an arbitrary benchmark, isn't it? Yeah, of a week.
Yeah, and you're setting yourself up for disappointment, like you just said. What happens if you have a losing week or a losing couple of weeks, whatever? forget all that. Focus on being the best executing trader you can be. The results will take care of themselves. Whether it's 120% in a year or whether it's 30% in a year, who knows, depending on the approach and the system or whatever. But I think that he's setting himself up for disappointment with that. That's quite a substantial goal. I'm not saying it can't be achieved, but you're better off promising yourself, under promise.
Yeah.
Let the market, let your trading over deliver like you say, depends on the market conditions, because it's a dangerous path to tread otherwise, putting that type of target against your trading.
I think that's great. Focus on being the best trader you can be. And on that note.
Yes, absolutely. On that note, my name's Charlie Burton.
My name's Ali Crooks.
Trade safely out there.